Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at the trade desk.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and just before we get into today's stock, we do want to mention a really useful chart tool for investors and traders. If you're looking for some help reading trading charts a bit more clearly, you can check out VIP Algos through the link below in the description.
Right, it's a TradingView indicator suite, right?
Exactly. It shows these visual buy and sell chart alerts, trend direction tools, and even support and resistance zones. Plus, it gives you take profit and stop loss planning areas.
Which is super helpful, and it works across, like, a bunch of markets.
Yeah, stocks, Forex, crypto, gold, indices, futures, you name it. But just remember, VIP Algos is an educational chart analysis tool only.
Right, definitely not financial advice.
No, definitely not.
Yeah.
It does not place trades for you, and, it absolutely does not guarantee profits. Trading involves risk, so always manage your risk and do your own research. Also, just a heads up, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Awesome. So setting the stage for today. Imagine a company growing its revenue by double digits, right? They're operating with absolutely zero debt, and their own executives are just buying up massive chunks of the stock.
Sounds like a total Wall Street darling.
Right. But then you look at the chart, and its stock price has plummeted nearly 80%.
It's a breathtaking contradiction. You don't usually see a company with this pristine balance sheet trading at an 80% discount from its 52-week high.
No, usually when a stock drops from like over $91 all the way down to the $18 range,
Yeah.
the underlying business is just in a total free fall.
But the business here is actually maintaining incredibly strong top-line revenue growth. And that tension, that's the core mystery we need to unravel today for you.
Yeah, we have to figure out, are we looking at a falling knife that's just going to keep cutting anyone who tries to catch it, or...
Or is this an asymmetric mean reversion opportunity?
All right, let's move into the wealth building context.
Right.
Because when retail investors see a chart that has bled out 80% of its value, the immediate instinct is, well, it's usually just a binary emotional reaction.
Oh, totally. Half the market wants to run away screaming.
Yeah, and the other half wants to blindly buy it just because it looks quote-unquote cheap compared to last year.
But, cheap on a chart doesn't mean it can't get cheaper in reality.
Exactly.
To build wealth over a long-term portfolio, you really have to separate the short-term macroeconomic panic from the actual, nuts and bolts of the business.
Right, because this is definitely not a quick day trade bounce we're looking at.
No, not at all. We are analyzing a potential mean reversion play that's built on this massive secular shift in advertising. The shift of ad dollars moving from traditional media into programmatic digital channels.
So just for someone new to that specific term, what exactly is a mean reversion play in this context?
Well, mean reversion is essentially the financial law of gravity.
Okay.
It's the theory that extreme price movements, whether way too high or way too low, will eventually revert back to their historical average, their mean.
Once the temporary panic or euphoria kind of just fades away.
Exactly. So the thesis here is that the market is just so panicked about macroeconomics that they are severely mispricing this long-term shift to programmatic.
Wait, so when you say programmatic advertising, what does that actually look like in practice? Because I think a lot of people just picture Don Draper in a boardroom pitching a campaign.
Yeah, the Don Draper days are completely gone.
Right.
Programmatic advertising means the entire process is automated. It's totally algorithm-driven. Instead of a human negotiating a contract for, like, a digital billboard, machines are bidding on digital ad space across the internet in literal milliseconds.
That is wild to think about.
Right. The moment you click on a website, algorithms analyze your demographic data, and they hold a micro-auction.
In milliseconds?
Yep. The highest bidding advertiser gets to display their ad to you before the page even finishes loading.
Wow. The infrastructure required to process, billions of those micro-auctions a day must be massive. And I imagine that shift to automation isn't going to suddenly reverse just because the stock market is having a rough year.
It won't. The shift is permanent. And if you believe in that long-term transition to automated ad buying, well, a massive drawdown in the stock presents a real opportunity.
But we have to be incredibly careful here, right? Because a stock doesn't lose 80% of its market cap by accident.
No, definitely not.
The market is pricing in some severe existential pain. For anyone looking at this, the question is whether this company actually has the financial foundation to survive the storm.
Right.
Because if they run out of cash before the macro environment improves, the long-term thesis is just dead in the water.
which is exactly why we have to lift up the hood and look at how much cash they're actually generating. Now let's look at the fundamentals,
Okay, let's hear the numbers.
because the story here is genuinely compelling. The financial health of the trade desk is pristine.
Even with the stock price getting crushed.
Yeah. Despite the macroeconomic headwinds crushing their stock price, their revenue trajectory is incredibly resilient. We're looking at a trailing 12 months revenue growth of 15.55%.
Trailing 12 months, just to clarify for everyone, meaning looking at their performance over the past entire year rather than just one single quarter.
Right, exactly.
Seeing over 15% growth while the stock is down almost 80%, I mean, that is a massive divergence between the actual business performance and the stock performance.
And the profitability metrics are what really jump off the page. They're operating with gross margins of 77.83%
That's huge.
and net margins of 14.57%. Their trailing 12-month diluted earnings per share, it stands at practically 89 cents.
How is it even possible to keep nearly 78 cents on every dollar that comes in? That feels almost illegal for a traditional business.
Huh. It's the beauty of a highly scalable software model.
Yeah.
Unlike a company manufacturing physical goods.
Where every new product requires more plastic, more shipping, more labor.
Exactly. Software scales infinitely.
Mhm.
Once the trade desk builds that core algorithm to process the ad auctions, letting a new client use that software costs them virtually nothing.
Right, the hard work is already done.
Yep. Every new dollar of revenue drops almost entirely right to the bottom line.
That makes sense. But valuation still matters, no matter how good the margins are. You can absolutely overpay for a great business.
Oh, for sure. Which brings us to the growth at a reasonable price metrics,
Mm.
also known as GARP. The trade desk is exhibiting 21.22% EPS growth,
Okay, strong growth.
and it comfortably clears Peter Lynch's famous GARP criteria with a PEG ratio.
That's the price to earnings growth ratio, right?
Right. And it's at just 0.53.
Oh, wow.
Yeah. Anything under 1.0 generally suggests the stock is undervalued relative to how fast its earnings are actually growing.
Okay, so the internal numbers look undeniably strong. A peg under 1 is great. But I have to ask about the elephant in the room here. The moat.
Ah, yes. The Google and Meta problem.
Right, because Google and Meta just dominate digital advertising. They're essentially walled gardens. They hoard all their user data and basically tell advertisers, play by our rules or don't play at all. So how does a company like The Trade Desk survive, let alone grow, against those tech behemoths?
By offering an alternative to that walled garden, think of Google and Meta like massive self-contained shopping malls.
Okay, I'm following.
If an advertiser wants to reach the customers inside, they have to rent space from the mall owner, they have to use the most proprietary currency, and they never actually get to take the customer's data home with them.
Right, Google keeps all the valuable data.
Exactly. But the trade desk, on the other hand, is building the open internet. It's more like a massive public highway system connecting thousands of independent boutique shops.
Oh, that's a great way to look at it.
They allow advertisers to retain control of their own data and target consumers across independent websites, streaming services, audio platforms, you name it.
I really love that highway analogy. It gives the advertisers their independence back.
And they're actively deepening that moat by expanding into retail media. Like, for example, they recently integrated 7-Eleven Japan's retail purchase data directly into their platform.
That is fascinating. So instead of just, guessing what a consumer might want based on their web browsing history,
Right.
an advertiser in Japan can actually target online ads based on highly granular first-party offline purchase data.
Exactly. Like they know you actually bought a specific brand of coffee at a physical convenience store yesterday.
In a world where internet tracking cookies are actively disappearing because of all these privacy regulations, that kind of hard, real-world purchase data is absolute gold for an advertiser.
Absolute gold.
All right, I'll grant you the business model and the moat are solid. And you mentioned earlier they operate with zero debt. Having a fortress balance sheet is great, but if the whole town around you is burning down due to macro conditions, is the fortress enough to keep growing?
I mean, it means you have the staying power to outlast competitors who are drowning in debt payments. But you're right. Eventually, the macro weather needs to change for the stock to truly recover.
That brings us to the catalyst timeline. What are the specific events that could actually shift this narrative and start putting out the fires in that macroeconomic town?
Well, the immediate internal catalyst we are watching is the upcoming August 2026 earnings report.
Okay, that's coming up quick.
Yeah. Given that they are maintaining that 15.55% revenue growth, A strong earnings beat against severely lowered market expectations could serve as a massive narrative reset.
Right, catching the market off guard.
And we are also looking at their aggressive leadership changes. Within a 48-hour window, they appointed a new, heavy-hitting executive bench.
Really? Who did they bring in?
They brought in Christy Argilon as Chief Commercial Officer and Ron Lamprecht as Chief Business Development Officer.
Let me push back on the timing there, though, because can new executives really move the needle fast enough for investor buying the stock today?
That's a fair question.
I mean, strategic pivots take quarters, sometimes years, to actually show up on the bottom line. Meanwhile, the stock seems entirely at the mercy of external factors they really can't control.
Well, the macro environment is the external lifeline here. The broader tech sector is waiting for a potential de-escalation in the Middle East.
Okay.
If geopolitical tensions cool and Brent crude oil can drop below the critical $85 threshold, it relieves a massive amount of pressure.
Hey, I need you to connect the dots for me here. What does the price of a barrel of crude oil in the Middle East have to do with a digital advertising software company's stock price?
It all comes down to the Federal Reserve.
Ah, got it.
When oil prices spike, the cost of transporting goods spikes, which obviously drives up broader inflation.
Right.
And when inflation is high, the Federal Reserve is forced to keep interest rates elevated to cool down the economy. Right now, rates are in that 3.50% to 3.75% range.
Which is suffocating for tech.
Exactly. But if oil cools off, inflation cools off. And if inflation cools off, the Fed finally gets the flexibility to cut interest rates.
And falling interest rates are basically rocket fuel for software stocks, right?
Because it triggers what we call multiple expansion.
Hold on, for the listener who doesn't live in a Bloomberg terminal, what does multiple expansion actually mean in this context?
Fair enough. It's about how investors value future money.
Okay.
High-growth software companies are valued based on the cash they are expected to generate years down the road. When interest rates are high, you can get a guaranteed 4% or 5% return just by leaving your money in a risk-free government bond.
Right, why take the risk?
Exactly. So the future cash of a risky software company becomes much less attractive. Investors demand a massive discount to buy the stock.
Which explains the 80% drop.
Yep. But when interest rates drop, those risk-free bonds pay almost nothing. Suddenly, the software company's future cash looks highly valuable again, and investors are willing to pay a higher, quote-unquote, multiple of earnings to own the stock.
So the stock price goes up even if the underlying business hasn't changed a bit.
Exactly.
That makes perfect sense. The cost of capital really dictates the valuation.
Now let's pivot to the chart.
Let's do it.
You mentioned earlier the stock is trading around $18.59, and it's down almost 3% just on the day. The price structure right now shows severe, almost historic oversold conditions.
It's just been hammered.
Truly. It is sitting 79.7% below its 52-week high and hovering only 9.4% above its absolute 52-week low.
And when a stock is compressed that tightly against its floor, the valuation metrics usually follow suit. The price-to-earnings ratio has compressed down to 20.35, and the price-to-sales ratio is a mere 2.96.
Which is incredibly low for this sector.
For the listener tracking this at home, a PE of 20 for a high-growth tech stock is basically the clearance rack. Usually, highly scalable software companies like this trade at multiples of 50, 60, sometimes even 100 times their earnings.
We are looking at a classic base-building technical structure here.
What does base building actually look like on a chart, visually?
It basically looks like a stock that has stopped falling and is just moving sideways in a tight, flat channel.
Like it's just exhausted.
Exactly. It happens when sellers are simply running out of shares to dump. Everyone who wanted to panic sell has already sold. We could see this in the subdued trading volume, which is currently running at only 0.58 times its historical average.
Wow, practically cut in half.
Yeah, it suggests total seller exhaustion. When volume dries up like that at the bottom of a chart, any positive catalyst could trigger a very sharp relief rally, just because there is no downward pressure left.
But the most compelling part of the chart isn't just the price, it's who is stepping in to buy at this price.
The insiders.
Yes. When we look at the squeeze watch indicators, we are seeing a massive cluster of insider buying. I'm talking about smart money here. Over the last 90 days, corporate insiders have purchased 476,107 shares.
Across 21 separate transactions, too.
Right. That specific volume of cluster buying yields an insider sentiment, MSPR, or maximum sentiment price ratio of exactly 100.
Wow.
That is the most mathematically bullish signal possible on that specific metric.
We really have to read the psychology of the tea leaves here.
Absolutely. Insiders, the executives who actually see the daily financial dashboards of the company, who know exactly how many ad auctions are happening, they do not aggressively try to catch a falling knife in a 77% drawdown unless they clearly see where the concrete floor is.
Right. They know something we don't.
They are putting hundreds of thousands of their own dollars on the line. Now, obviously, technicals and insider flows are always probabilities. They're never guarantees. But when insiders back up the truck at these levels, I mean, it demands attention. So what does market sentiment look like? Because clearly the insiders are thrilled, but the brighter market seems terrified.
It is a complete tug of war in the narrative right now. On the bullish side, there is genuine excitement over that rapid 48-hour hiring spree of top-tier talent.
Bringing in those heavy hitters.
Right. Bringing in Lamprecht, Argilan, and they also brought in Vinny Rinaldi. It signals a very aggressive pivot to monetizing retail media. It shows the company is playing offense, hiring these big names to strike deals with retailers, while other companies are just playing defense and laying people off.
But the defense side of the narrative is heavily weighed down by the broader software sector. The market is spooked, and a lot of that stems from the recent IBM Q2 warning.
Yes, that really shook things up.
IBM essentially warned that their enterprise customers are slashing their traditional software budgets across the board.
And the primary reason for that is the artificial intelligence arms race. Every enterprise board on the planet is demanding AI integration right now.
But why would an enterprise cut their ad software budget just because they want AI? I mean, they still need to advertise.
Because AI requires massive physical infrastructure. These companies are taking the money they used to spend on flexible software subscriptions and redirecting it to buy physical AI compute hardware.
Like NVIDIA chips and stuff?
Exactly. Massive servers, cooling systems, and specialized graphic processing chips. They are hoarding hardware. The fear in the market is that advertising software, even high-quality programmatic software like the Trade Desk, is going to be the victim of those temporary budget freezes.
So the ultimate question is, can the Trade Desk's internal optimism, all that aggressive insider buying, really swim against a bearish macro tide, where their enterprise customers might literally have their checkbooks frozen?
Well, let's talk about the risks, because that bearish tide is substantial, and we really need to look at what could fundamentally break this investment thesis.
I'll take the lead on this because the macro deterioration is the most pressing threat to the downside. We are looking at a very real risk of an oil shock. If geopolitical tensions result in a U.S. naval blockade on Iran, it keeps Brent crude elevated. And as we discussed earlier, that forces the Fed into a higher-for-longer interest rate environment.
Which crushes valuations.
Exactly. In that scenario, the cost of capital stays suffocatingly high. New-term corporate ad spend will absolutely dry up. I mean, even with a zero-debt balance sheet, you cannot grow your revenue if your clients' credit lines are frozen and they literally can't afford to run marketing campaigns.
That is the overarching macro risk, for sure. But there is also a speculative yet critical technological risk, and that's open source AI commoditization.
Open source meaning the underlying computer code is just freely available to the public. How does that threaten their moat?
Well, we are seeing incredible leaps in open source AI capabilities right now. For instance, China's Moonshot AI just released Kimi K3, which is the largest open source model ever.
Wow.
And it's currently beating top proprietary models on key reasoning benchmarks. Now, the Trade Desk's moat has always been its highly sophisticated proprietary targeting algorithms.
Right. They spend years and millions of dollars building the software that decides which ad goes to which person in a millisecond.
Exactly. So if highly capable open source AI models lower the barrier to entry, a brand new startup could theoretically download that open source code and build a world-class ad targeting algorithm without needing billions of dollars in R&D.
Oh, wow.
It could commoditize the very technology the Trade Desk relies on to justify its premium status. I mean, why pay a premium for their algorithm if a cheap open source AI can do the exact same targeting just as effectively?
That is a fascinating threat. So to summarize the bear case here, the bullish mean reversion thesis completely derails if macro budgets dry up entirely before this new executive team can execute their strategy, or if open source AI suddenly outpaces their proprietary data advantages, making their software easily replicable.
Spot on.
So with everything on the table, what's the final verdict?
Well, based on all the data, the fundamentals, and the technicals, we are assigning a bullish score of 7 out of 10.
A 7 out of 10. Give us the elevator pitch for why it earns that score, despite the massive macro and AI risks we just outlined.
The elevator pitch is this. The trade desk has been unfairly punished by a macro-driven technology sector route. It has been sold off indiscriminately alongside much weaker companies.
Right, thrown out with the bathwater.
Exactly. When you have a company maintaining 15.55% revenue growth, operating with an 80% gross margin and zero debt, clearing Peter Lynch's JARP validation with a 0.53 PEG ratio and seeing highly aggressive cluster buying by its own insiders, it offers a deeply asymmetric risk-to-reward profile.
Meaning the mathematical potential for upside from these $18 levels vastly outweighs the downside risk of the stock dropping further into the single digits.
Precisely. As for the time horizon, this is not a quick flip. We're looking at a 6 to 12-month hold. It functions as a value and mean reversion play as we head into the next earnings cycle and wait for macroeconomic stabilization.
But we do have to balance that upside with a very clear warning. While the upside potential of a mean reversion is clear, the macro risks involving oil, interest rates, and AI disruption are entirely real and completely out of the company's control. Please remember that our discussion today is for informational purposes only.
Yep.
It is not financial advice, and you must weigh your own risk tolerance before entering any position. Before we wrap up, consider this one final thought. With traditional television dying a slow death and tracking cookies being legislated out of existence, real-world retail data like knowing exactly what you bought at a convenience store might become the only viable future for targeted advertising.
It's true.
It raises a massive societal question. As advertising platforms integrate deeper into our physical retail purchases, how much privacy are we actually willing to trade for a relevant ad? It's something to think about as this technology evolves. And if you want a cleaner way to read trading charts, check out VIP Algos through the link below in the description.
Definitely worth a look.
VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts easier to scan, but it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.